Hey folks, how you doing? Mike Shorr, prospertrading.com. Wanted to talk to you today a little bit about allocation and risk and reward. Had a number of questions coming up the last couple of days, and so I thought I'd put together this video. And the way to approach allocation, as opposed to if you are a stock trader or even more than that, a futures trader, where the underlying value of the contract that you're trading is basically static. That's not going to necessarily be true for an options play because you could trade a spread on an option that is worth 25 cents. You could trade on a spread on an option that's worth $2. And it all is going to depend on the type of spread that you're putting on and the underlying and a bunch of different factors. But the important thing to remember is what you want to do in order to reduce the variance, which means the ups and downs that people sometimes experience in their trading accounts. You want to allocate the same amount of risk, not the same amount of contracts, the same amount of risk to each signal that you do. So for example, let's just say that we're looking at Facebook, and this has nothing to do with Facebook other than it is just an example. Let's just say that we're bullish on Facebook and we want to put on a call spread. And let's just say that we're putting on the October 170, $175 call spread. That's going to be trading somewhere. Let's get the actual market. It's going to be trading about $1.05, let's just say. And you just say, I want to buy this. So the first thing that you have to do is you have to say, okay, what kind of account size am I trading? Because that's going to matter a whole lot. If you're trading a larger account size, well, then you're going to allocate more dollars towards something because it's based on percentages, not based on lot size. The rule of thumb that I use is 3% for a swing type of trade. Yours could be more, it could be less. As long as you're consistent with that allocation, I would say that it should somewhere be between 2 and 5% generically, though. You don't want to be putting half of your portfolio towards any one trade, and you don't want to be putting less than 1% towards any one trade because you really can't make any money doing that. So let's just say that 3%. And so that if, let's just say generically, I have a $25,000 account that I'm going to allocate 3% towards any one signal. Well, that means that I'm going to be risking $750 per signal that I do. And let's just say that we're looking at Facebook here. If I'm risking $750 for a 100 or for a $1.05 signal, well, I'm going to be able to do 7.14 lots. We know that we can't do 7.14, but we can round up and round down. In this case, we would round down. I would do a 7 lot. That's going to keep my variance low. I'm going to have the same amount of money out on the table each time. So let's take the example from a credit spread, because that's different. We're the ones receiving. Let's just say that instead of I'm still bullish on Facebook, but I want to sell a put spread as opposed to buy a call spread. So let's just go out and look and say, well, I want to sell the 150, 155 put spread. Still a bullish play, and I'm not saying I'm bullish on Facebook. It has nothing to do with it. But in this case, I'm going to be, if I trade this mid-market, the market on this is 78 bid at 80, so 79 cents is reasonable to take in premium. Well, do I put in 79 cents as what, and then I do 9 or 10 of these? No, because why? Because it's my risk. My risk at this is the most I can lose in the debit spread that we talked about before was whatever I paid in premium, which was $1.05. Here, my risk is the width of the spread less any premium that I take in. Big difference. So now for this one, I am going to, the width of the spread is $5. Let's just say I take in 80 cents. So I am going to be risking $4.20 per. So I'm only going to be able to do, if I round up, a 2 lot. It'll be a little bit more than $750 of risk, but in the grand scheme of things, it's in the neighborhood of what we're trying to do here. So the important thing to realize is what is at risk. In a debit spread, it's whatever you paid for it. In a credit spread, it's whatever the width of the largest spread that you sold, less the premium that you take in. And that's what you base your allocation on, not on lot size. It's on risk, not on lot size. Okay, I just want to remind you guys, this is Mike Shorr from ProsperTrading.com, www.prospertrading.com. And I want to tell you that stocks and options trading involves substantial risk of loss and is not suitable for every investor. The valuation of stocks and options may fluctuate, and as a result, clients may lose more than their original investment. All trading strategies are used at your own risk. All right, everybody, thank you very much. Mike Shorr from ProsperTrading.com signing off here. Have a great day.